Hmm.
Empirically, how does active share relate to the three pillars of active management?
Yeah, so in our paper I wrote in the Financial Analyst Journal, I tried to summarize what I have learned from doing research on active management. And I put that together in what I call the three pillars framework um, that I argue summarize what I think um, active managers need for long-term success. And these are three things that they all need all at once. Not just two out of the three, you really all need all three at the same time. So they need skill, conviction, and opportunity. Skill to identify investment opportunities, then the conviction to pursue an investment strategy that requires a certain courage of one's convictions. It's not easy to replicate. And then you need opportunity internally in the fund complex from your investors that you don't have too many constraints, but you also need to operate in an external market, right, where you actually invest your cash, where there are actually investment opportunities, where there are stock selection opportunities. And then I relate those to active share. So, for example, if you have a high active share, it doesn't mean you are a skilled manager, right? You don't need skill to have a high active share. Active share is not a measure of skill. But if you have strong convictions, you would naturally have a higher active share. And if you have a lot of opportunities in the market for security selection, it is natural that you would have higher active share. And so a high active share manager, in my view, will naturally be a manager with strong convictions and more opportunity, but not necessarily skill. But if the manager doesn't have skill and the markets are very competitive, then how long can high active share managers with strong convictions and opportunity, how long can they survive in very competitive markets? And that's why I say then in the end, well, if the market is really competitive and you have a manager with a high active share strategy that has good long-term performance, then that manager surely must have skill.
Hmm.
Can you talk more about patience specifically and how important that is? Yeah, patience, I use it as my example for investment strategy that requires conviction. Um, so if you go back to conviction, if a manager's active strategy doesn't require conviction, then why would it persist, right? Is a strategy successful? And what prevents too much money from flowing in? What prevents too many other managers from doing exactly what this manager is doing? And so without a strategy requiring a certain courage of one's convictions, where there are some economic frictions that you need to overcome, right? Why would it persist? Key example is Warren Buffett, right? It's actually very hard to do what he does, right? And so I think it's currently the case that, especially in mutual funds, most investors evaluate their managers over fairly short periods of time. And so it's a fairly impatient world. And so it's hard to be
Yeah.
patient in an impatient world. There's a certain mismatch between the expected investment horizon of a patient manager and the time over which that manager is evaluated by the investors. And even just hypothetically, let's say a patient long-term manager is right about a certain bet. That manager may be wrong about that bet in the short term, and he's evaluated by the investors in the short term, right? And that mismatch creates an economic friction that makes it hard to be a patient manager and active. If you look empirically, we find that most active managers are not very patient. Right? They hold stocks for 1 to 1.5 years on average. Most patient capital is not very active. It's the combination of patience and high active share that is very rare. And so then if you think about markets where I posit, right, there are some long-term investment opportunities that only patient managers can exploit. And for reasons I just tried to explain, there's relatively few patient managers that pursue those because this is really hard to do, right? Unless you have really, really patient investors. there may be particularly good opportunities for patient high active share managers.
Okay, that gives me a follow-up question. You talked about the lack of persistence of the unconditional active share out of sample. If you look at patient high active share active managers, has that been persistent, or has that yeah?
Yes. The exercise that we did is we look at active funds in 2 dimensions independently, right? Active share versus patients. What we found was that on average, the high active share managers did not underperform, but there was also no strong outperformance in our sample, except for the high active share managers that were also patient. So all of the outperformance, also in my earlier study, really came down to that group, that is both high active share and patient. The less patient high active share managers also did not underperform, so arguably may still be a decent starting spot to start with. But it was really the combination of patients and high active share that on the one hand is rare, and on the other hand, it drove the outperformance among the high active share funds.
Interesting. I have to ask you, how was the active share concept initially received by both academia and the industry?
So by now it's a fairly standard measure, like tracking error. I think initially, a lot of academics were very skeptical about our results because it goes against the grain of the conventional wisdom of active management. When we originally did our paper, we were so astonished of how many low active share or closet index funds there were in the market. I think that in practice or in the industry, it has become a standard measure that is useful to on the one hand find closet indexers, but also on the other hand find funds that actually do a lot of security selection, and there's lots of funds that do that. But it's a very simple measure to find those funds.
It definitely does go against the conventional wisdom. We've kind of been beating the index funds drum for a long time at our firm, and yeah, I mean, this is definitely something that somebody who promotes active management can say, well, hey, look, there's this research that says that there are cases where it can make sense. There's a critical paper in the Financial Analyst Journal, 2016 paper that I'm sure you're familiar with, deactivating active share. I'd love to know what you think about their critique.
Yeah, it's good to have a debate. And I also was glad that they were able to replicate our original results without any problems. And that's always a relief, right? That there can be issues with replications. So if you go back to our paper, I talked about 3 big results, right? 1, low active share funds with strong statistical confidence continue to underperform. Then unconditionally, that active share in our particular sample outperformed. That result did not prove robust over time. And then the third result is that if you combine high active share with past performance, we found strong positive performance persistence that in a recent Financial Analyst Journal we documented was persistent, and that was robust in the last couple of decades after our first paper was published. And so this 2016 paper that you're referring to focused on the second of our 2 results, the one that has proven to be the least robust. They made a very important point that I talked about earlier, is that there's a very big difference in the typical active share of a large cap fund and a small cap fund. Large cap funds tend to have significantly lower active shares on average, and most small cap funds have very, very high active shares. There's simply not much variation in active shares among small cap funds. Almost all are very high, right? The real variation in active share comes from large cap funds. What they do in this paper is they then sort on active share within the style. So they sort on active share only within large caps and only within small caps. And then they look at it basically within style, and then they aggregate. if that makes sense. So they do it sequentially. So they decide whether or not a fund is high or low active share within a certain style. In my mind, that kind of confuses a bit what ActiveShare is trying to do. And then what they find is that, if I remember correctly, is that the main result that high active share funds outperform in that original sample, that is not robust once you adjust what active share means, right? And so effectively what it means is they are adding large cap funds with active shares that are actually not that high to the high active share group, right? Because they do it just within large caps. And so in my mind, they're adding noise to active share, and that weakens the results. But at the same time, it's a very important point that style matters for active share a lot, right? And that if you're looking at a small cap fund, almost all of them have a very high active share. But I don't think that you can reduce active share to just style, right? And that's also why I point to all of the other results about low active share funds significantly underperforming, which they also report, but don't talk about in their paper. And then the positive performance persistence, as well as a large range of other results in my too many papers I've now written in this field as well.
There's a chart in a white paper from Vanguard showing increasing dispersion of benchmark relative performance with increasing active share. How concerned do you think investors who are seeking high active share funds, like they hear this podcast and say, cool, I'm going to go find a high active share fund, maybe a patient high active share fund. How worried should they be about that increasing dispersion?
Yeah, the increased dispersion among high active share funds is kind of inherent in, if you dealing with a fund with a lot of security selection, then that fund is more different from the benchmark. And so you would expect that fund to be more likely to have returns that are different from the benchmark, right? And that creates the dispersion. With all respect to Vanguard, I think of that issue as not really an issue about dispersion per se. I think of it as an issue of idiosyncratic risk first. And when you think about what investors should be doing, I think investors should think about their overall portfolio, not the dispersion of idiosyncratic risk of a particular fund, but rather how, if you take your overall portfolio, what happens to your overall portfolio if you add or do not add that particular fund to your overall portfolio. And what you worry about is not the idiosyncratic risk of a particular fund, but how adding that idiosyncratic risk to your overall portfolio actually changes the dispersion in your overall portfolio. So where you don't like dispersion is in your overall portfolio. But adding a fund with more idiosyncratic risk, as you may very well do if you add a high active share fund, may actually be good for diversification, right? If the fund that you're adding is completely different than anything else you have in your portfolio. I think that's what's missing from the Vanguard discussion. They do not think about the overall portfolio. They don't think about diversification and how diversification can actually be improved by adding a product that has less overlap with what is already in the overall portfolio, or more generally, how idiosyncratic risk actually helps diversification.
And further to Ben's question, Martin, so we have listeners that range from, a curious DIY type to we have a lot of, experienced seasoned professionals who listen. So in your opinion, how should they decide whether to invest in index funds or to actually hunt for, a patient high active share fund that might beat the index?
I don't give investment advice, but I appreciate the question.
I knew the disclaimer was coming.
Yeah. Yeah, and I have my usual disclosure as well that I serve as independent director of an active manager. But if I would give advice, it depends on what you're trying to achieve and what you're trying to avoid. If an investor is very focused on avoiding underperformance and they don't have time to study active managers, and it makes sense to invest in low active share funds that are very inexpensive. I think one aspect that we haven't talked about is downside risk protection. And there's actually considerable evidence that we also go through in our Challenging Conventional Wisdom paper, is that active managers have real skills in risk management and particularly downside risk protection. And if investors are very interested in that, but also are interested in potential outperformance, but they're also really worried about protecting the downside, especially in times that the market is not performing well, right? Then they may consider high active share funds that have strong past performance, a strong evidence track record of protecting the downside in bad times over a longer period of time, right, at a reasonable fee. But that takes research, that takes time, right? That is really not easy to do.
Yeah. But unlike the conventional wisdom, it's not a foregone conclusion. It sounds like, based on your research, that you're going to underperform if you try and choose an active fund.
Yeah, that's my conclusion. It's long as, again, it's a fund that is worth its fee, right? That's actually very different and not a classic index fund.